So you've got some properties and you are trying to figure out whether to refinance or not. You see and hear this word getting thrown out all over the place. No idea what it means. Today we're going to unpack refinance. Young Money Hackers, welcome back again. We are here with myself, Kid, and Charlie. We're going to talk about refinancing today. So Charlie, tell us, what do you know about refinancing? Come on.
So I know that it's a pretty good strategy for people that have equity in a property and they want to do something with that. I mean, I think a lot of us understand, have a broad understanding of what refinancing is, but I think a lot of people do it because they might have seen a better interest rate somewhere. So they think, better refinance. Boom, that's the main port of call. That is the main reason that they choose to refinance a property. But we're going to go over why people should be refinancing, when it's a good time to do so, and actually how to go about this in the first place. So a lot of people have property, but they don't even know that it's an option for them to even do this and how to go about it, how much it costs. So there's some of the options that we're gonna cover here in this episode, and go through an example as well.
Sure. The thing about the reason for refinancing, a lot of interesting. I feel like that is certainly the reason that we are told to consider, because that is the easiest way for finance brokers and banks to leverage on more lending, right? When the interest rates are lower. Because it's interest rates are lower, so it's a pretty easy sales pitch. So that's why everyone can consider refinancing. But I think there are more reasons to refinance than just lower interest rates. Although that is a very, very strong benefit. So, but initially though, you mentioned a very important thing about equity. I think we need to explain what equity is for people. So what is equity?
Yeah, so equity is basically the amount of value that is currently tied up within your property minus the loan that you have against that property.
Sure. Give us an example.
So if we have a $1 million property and it's worth $1 million, but we owe $700,000 against that, well, then we have $300,000 of equity. Now, the cool thing about equity, though, is that it changes over time. It doesn't just stay the same as when you bought the property. And I think people can forget that. It's if you buy a property for $1 million, in 2 years' time, it might be worth 1.2.
Yeah.
So if you've paid off $300,000 of the loan and you've built $200,000 and the property has gone from 1 million to 1.2, that's a $200,000 difference in equity. So now you have $500,000 total in equity in that property. So if we were to refinance that, there are so many options. For example, if you kept it with the same bank and you decided to refinance the whole 30 years, you would have a 30-year loan term, but you would not be paying the same mortgage. You'd be paying a different mortgage because it's on a smaller amount.
Another thing you can do is you can just max out the borrowing capacity again for the value of the home within itself as well. So if your property has gone from 1 to 1.2 million, and let's say you initially purchased the property at 80-20 LVR, right? 80% LVR, which is a loan to value ratio, you borrowed 800 grand. You paid out 300,000. The property went up 200,000. So the equity went from 200K to then being what is it now? 400K plus 700K, right? Because you paid out 300K of 800K, so your principal is now at 500K, right? These are big numbers, by the way, guys. We're not even playing with $1 million properties for most young money hackers anyway. But but just for simplicity of calculation, that's what it is. Then now your property is worth 1.2 million. You've got $500,000 in principal and loan amount. You can borrow 80% of 1.2 million, right? Which then is what does that work out to be? So that's 24,000, so $960,000 that you can borrow, which will then pay off your previous principal at $500,000, and then boom, you got your $460,000 in cash now. Yes, you are paying repayments on that, but with $460,000, you put that down as a down payment for another $1.2 million house right there. So that's the function of refinance. I'd like to see refinance as being, it's kind of like selling your property without selling your property. You're cashing out, and then with that cashing out, you can then move to subsequent properties. And you know what? My recommendation for investors out there is that don't sell your property if you can. Keep it.
Yep,
and give it a reason to why you should keep it. Put the highest best in use behind it. And then don't just cash out because you want to cash out. Cash out when you have a good opportunity to invest. So if you're not going to invest in the next 6 months, don't do any cash out, because once you cash out that kind of equity, you're going to buy something stupid like a car or something.
Yeah, exactly. I was about to cover that point. You did some crazy maths on the spot there. That was really impressive, dude. Well done.
Oh, thanks, man.
So
I was cool with it, you know what I mean?
yeah, he's just a talent. So that was a really cool example.
And I know people want to really consider why they're refinancing, like cheaper interest rates and all that. That's a big reason I see it. But the thing is, even when the interest rates are higher, I think refinance could be valuable, right? Say there's like a $1 million, $500,000, $1 million deal that's going to happen and you need a $100,000 deposit. You don't have it. But there's enough equity to actually then cash out that $100,000 to then buy your subsequent property. And that property, if you buy it, is going to give you another, 20, 30K in your pocket every year passively. You'll be stupid not to buy it. All right. So then you need the money, but it's going to cost you another 1% more on your financing. On an $800,000 loan, 1% is $8,000 a year extra that you're paying. Which is
So what you're saying is don't always focus on the lower interest rate. Focus on what you can do with those options when you do refinance.
exactly opportunity cost. We're all businessmen, right? We're all out there trying to get the best investment out there. If there's an opportunity there to actually seek out and the numbers are right, then why wouldn't you do the cash out? Just because you pay 1% more. And don't worry, once you have that loan, another day will come when all the interest rates are going to come back down again. And that's when you can just refinance the entire portfolio altogether. And that's when you're going to benefit. And would you rather 1% decrease on a loan size of $800,000 or 1% decrease on a loan size of $3 million? Think about it. What a saving that would be when interest rates come back down and your rents are coming in just through the door, just the way they are. The cash flow is going well. That is your payday. So why wouldn't you be increasing your portfolio throughout the high interest periods? Why wouldn't you be increasing your portfolio all the time?
Yeah, exactly. But you make a really, really, really solid point. It's like just because, like when interest rates are currently high, like they are right now, if you were to do something, when I say that, I mean like if you were to buy another property, the economy will change. Things will go up in value over time. You know, interest rates can't go too much higher from here, even though that might happen slightly. When interest rates fall and property values increase, that is where you get the biggest bang for your buck in terms of a refinance, because you not only have decreased your expenses in the whole thing, but you've also increased your equity. So the payments,
Exactly. Yeah.
But you've also increased your equity. And when you do that refinancing, when you go ahead with that, it's like the amount you can do with that is crazy. Yeah, it's really good.
That's where the snowball comes in. Yeah.
100%. It goes the other way though as well. If you over leverage, this is where people got to be careful. You know, like we got to talk about risk management a bit as well. Like if you over leverage, and you know you've got a 90% LVR, so you're constantly borrowing up to your eyeballs with only 10% equity in at any given time, and property values fall. Well, the banks can margin call you. The banks can audit your investments, and you're going to have to come up with a difference, which can be hard. But
I have a view on that though.
Okay, cool.
I have a view on that. Okay, here's the thing. Focus on cash flow and serviceability. If you can service the loan, who cares if you borrow 90%, 100%, 150%? I know these are ridiculous numbers. I get it. All right. Yes, it's easy to service a loan when you borrow 20% of the value of the property you're buying, right? Because the rent's probably going to more than cover that, right? But here's the thing. If rents are coming through the door, if you are smart enough to identify cash flow strategies for the property that you're acquiring, right? This is why I was trying to say before as well. When you refinance that initial property that you bought for $1 million, right? And it's going to go from paying 4% mortgage to 5% mortgage, right? If your rental yield is 4.5%, all right? Going from 4 to 5% is going to put you in the negative. But if you had focused in the initial acquisition with a high cash flow strategy, which is what we're talking about in our podcast every day, right? And your property was yielding 6 to 7 or 8%, and you're paying 4%. That 4% repayment going to 5% isn't that big of a deal, right? So that allows you to then do your subsequent refinancing and cashing out and do more investments and things like that. Going back to the example of being highly leveraged as well, if you're leveraged to 90%, all right, and let's say 90% borrowing on $1 million, things is going to make you pay 45 grand a year. But if your income is 70 grand a year from that property, you have the serviceability. Serviceability is the affordability to meet the repayments, right?
Yeah.
Then the banks aren't going to come in and just willy-nilly trigger that, Because what I've also realized on a macroeconomic scale is that banks are busy now as they are. If they start triggering foreclosures across all of their portfolios, right, A, it makes them look terrible because people are going to start throwing a massive fit collectively, right, with me and all the rest of it. They just don't have the time for that kind of crap. And two, it's a lot of administration where the cost of that administration outweighs any recovery of the principal. So they're going to look at serviceability. Can people service it? Because you know what happened during COVID when this was a bit of an issue, right? All the property prices fell back down. They know that it's momentary. So what did they do? They just defer the payments. That's what they did. So the thing is, I used to work in foreclosures. I used to work in, liquidation and mortgage in possession, right? In a legal capacity. And you know what? It has to be a pretty damn dire situation. Like people think it's like, oh, if I miss a payment, the bank's going to come in and see your property tomorrow. Nah, they don't have time for that. They're not going to come after your $300,000 property because you missed a payment for a week. No, look, that's just, don't have to take my word for it. Always pay your repayments on day, right? Always be quick on your repayments, okay, guys? This is not to encourage people to be late on their payments, but always pay your payments. But that's not the end of the world. You just talk to the bank and then just figure something out. And in the meantime, focus on a strategy to increase your cash flow on the asset that you have. That's a good pressure to have as an investor. It's a good pressure to have as a landlord to get as much money as possible for your property in the best strategy known to yourself. That's why you guys are here listening to our podcast. That's why you subscribe to Young Money Hackers, so that you can hack out the best money when you're young for the property and the investments that you're going to embark onto. So
that's a really good point. Yeah, it's some really good points, man.
Refinancing, like high leverage, high leverage is bad, but it's also good depending on the circumstance that you're in. And that's the light I'm trying to bring. We're not here to give out a hard and fast rule for everybody to follow, Like, we're not here to say, oh, you got to do A, B, C, and you'll become rich. No, the way people become rich is different, even within the realm of property. So people have to know. I think that's a philosophy that we're gonna focus on, right? It's just Young Money Hackers. It's not about, oh, there's only one path to success. No, we are here to show you the world that is property. And you guys decide on what you're going to do about that information. Some of you will listen to this, do absolutely nothing. Right? 99% of you will listen to this will do absolutely nothing. 1% of you will do something about it. And that'll refine your craft and art. And that is going to drive the decision behind whether or not you're going to borrow 90% or 80%. Whether or not you're going to cash out, refinance, buy yourself a new property, and just keep going. Sorry, I got a bit salsa. We got there.
No, that was an awesome tangent. That was a really valuable thing for people to know, actually. You know what? Understanding how the banks behave is a hugely beneficial skill for people to have. This whole thing, as you said, is a skill set I think that people can get better at over time. But yeah, it's interesting how you mentioned serviceability, not just within your personal, like what you can personally borrow from the banks, but also within the asset itself, how much that can produce to cover yourself. Half of the risk management is done within the property, not just your own serviceability. So that's super valuable. So if someone wanted to go in and refinance, maybe they feel like their property might have gone up in value. Like, what do they even do? Because I don't know anything. What do they actually do? Where do they go? Who do they talk to? What's the process? Well, really quick, guys. Property investing can feel like an extremely overwhelming process because it's the biggest financial decision most of us will ever make. That's why we've developed these property investing calculators that are extremely easy to use. All you have to do is put in your numbers and it will tell you if your property investment is profitable or not. But that's not all. We also have a mentorship experience.
And that's right. We want to share with you all the juicy details through Young Money Academy, where you can learn step by step on how you can see yourself through to that end goal where you're profitable on all your property investments. We also have free resources available, so check them all out at youngmoneyhackers.com. Now back to the podcast. What they need to do is they need to reach out to a finance broker, a good one, like a really good one. And let's use this opportunity to talk about finance brokers, right? Okay, the difference between banks or finance brokers, right? Yeah. So here in Australia, finance brokers are everywhere. Banks are everywhere. Okay, they both seem to lend out money. What's the function of each? Well, finance brokers, they come and ask about your situation. How much money do you make? How much money you got? What is your job? They use that information to package an application for you on your behalf to the banks. Not just one bank, multiple banks. They have access to all the loan products out there available for you, which all of them have different interest rates. Could you believe that there are literally like thousands of different banks offering, home loans, and they all have different interest rates, and they all have different conditions as well. So like if you're like a medical professional, or if you're like somebody that has that is a business owner, right? There are lenders out there that have a preference on certain types of mortgage holders. So people, depending on your background, they can give you better benefits, and they just know you better. So the broker actually will identify that and find the best product appropriate for you, right? You might be in a position where you have more cash than your income. Then there are lenders out there that favor that, and it is better to go for those kind of lenders. And brokers know this better. For you to go through the exercise of going to every single bank and doing the research, telling each of them your situation in the exact way, shape, or form that they require, to me, sounds ludicrous. So you would think that there's a service charge for what the brokers are doing. The answer is no. They actually get a commission on the amount of money that they loan out from the banks. So the thing is, they are receiving the money from the banks, but they're using your information. They're collecting your information so that it goes to the banks in a nice, well-administrative fashion. So that it goes to the banks, and the banks then process it quicker and sooner, because they receive information from somebody that knows what they're doing, right? That's a finance broker. And that's how it happens. So then you might ask, okay, well then are the products that are coming through the finance brokers more expensive than the products? So when I say product, loan products and interest rate, are the interest rates coming through the brokers higher than the interest rate coming from the bank itself? The answer is none. In fact, in Australia, legislatively, by law, finance brokers cannot charge a margin of profit on existing retail loan products offered by financial institutions in Australia. So that means you're getting the same product anyway, okay? So yeah, can you have access to that same product? Yes, you can, but it's one of 1,000, and you got to do your own research to find what that is. Why bother doing that? And plus, why wouldn't you just get somebody to write you the best application to get yourself the loan, design in a way for you to acquire the loan, right? So that's why you need to work with a finance broker. So if you go to a finance broker and I say, hey, listen, I have this property here, I think it's gone up in value this much, then the finance broker will go through the steps with you. What are the steps? Okay, the steps are, first of all, identifying your serviceability and your cash position and all that, just so that the banks will know your position that you're in right now. So always have a job, always have some sort of income outside of property. That's important. Unless you have a 20 plus property portfolio, then that is your job, right? That's a different story altogether. But what they're going to do is then they'll look at that. They'll identify a bank that could do the best job at refinancing you, and the size of your refinance of it itself. So, there's obviously different loan products for, if you're borrowing 200K to 300K to 1 million, 2 million, 2 million to 5 million, 5 million, 10 million, right? So they're all different kind of loan products out there. And if you think about it, lending out $2 to $5 million is a lot more wholesale, right, than lending out 200K. So the banks are going to be giving you slightly better rates depending on where you're going to go.
So the bigger the mortgage, the better the rate they're going to give you. The smaller, slightly not as good.
Exactly. Just think about it. It's just business, right? 200K loans, you got to do 10 of them. You got to process 10 applications to get to 2 million. But one $2 million loan is just the same amount. And all the banks want is just the money come back for the money that they lend out. So they want that 5.5-6% return on the money that they're handing out. That's all they want. So they want to do that in the quickest and the easiest way possible. So that's why different loan products will go to obviously and attract different rates. And so once they've identified the product, what the finance broker is going to do is liaise with the bank so that they can send someone to do a valuation on your property. Valuation is a massive industry. So value will come through your property. Either they will come through it themselves, or they might do a desktop valuation. And then and you want that valuation to be nice and high, so that's what the market is willing to pay for your property right now without actually having to sell the property. So then based on that, they're going to then loan on that, as well as with the assessment of your income and what the property is generating, et cetera, et cetera, et cetera, et cetera. So that's how refinancing would actually occur. And I think you guys are stuck and you don't know which brokers are going to do the best job for you. Look, Young Money Hackers, we're helping people out. We got our own brokers that we're using that's brought us to the level of success that we're in right now. So reach out to us and we will hook you guys up with the right broker.
Yep, only the best. So that's really cool. So the simple process for someone is just they will need to go to a finance broker. They'll be assessed on what their serviceability is based on their income and their assets and all of that. Connect them to a bank that'll be best suited for them, whether that be the bank they're already with or someone else. That's another story. Doesn't really matter. The property will then be valued based on their valuers. They'll have a valuation, and then they'll have options. So you could either you could choose to refinance restart the 30-year loan period all over again. You'd be paying a slightly, a smaller mortgage.
Mm-hmm.
Or you could like cover the previous loan, take out more money so you have cash left over, which you will be able to do something with. But that's just a few of the options that they'll be able to provide you with.
That's right. And then sometimes you don't even need to do a cash out refinance. So if you're just going for another property and you know you have some equity in the property before, and how do you know you have equity? Then that's something that we should probably raise up beforehand, is that before you see a finance broker, get an idea of what your property is now worth, right?
Yeah.
How do you do that? Well, the least you could do is go to the most like swanky real estate agent in the area. Just give him a buzz and just be like, yo, I'm thinking about selling. What do you think my house will sell for? He'll be more than happy to give you a report on like how much it costs for free. Come on, right? And you would use like, RP data and price finder, which is like $1,000 a year or something, like some crazy amount of money, like the tools that most investors don't really have access to.
Yeah.
And they'll find out, or you can just go to the real estate company and just have a look at some similar properties that are selling at, for whatever you've got, right? So
just look at them.
Yeah, exactly. So then use that information and then go see, have an idea of what you're doing so that you're not actually wasting your time. But then what I would suggest, what it would look like 9 times out of 10 though, it's a cash out refinance is good, but this is how things are done really practically, and we're shedding more light into practices, not just theories, right? So what's going to happen is you're probably going to find an investment property that you want to buy first, right? And then you go see a finance broker and be like, hey, I've got this much money that could go in as equity, but it's not enough to cover 20%, 30%, whatever. You just go and say, oh, by the way, I would like to pull the equity from the other properties that I own. Is that possible? Right. So then that's when the cash out refinance will happen, but it will actually never hit your bank account. You will just go from that house directly to the new house. Does that make sense? So that it just flows right through. And imagine if you did this enough times and you're pulling equity from like 4, 5, 6 different properties to buy the next one. That's
how it's done. That's how it's done. Which you don't have to pay tax on, as in the money that you get from those assets. You don't have to go and pay tax on it because
you didn't sell it.
Exactly.
Yeah.
It's a literal one of the things I love most about property. Yeah. So
which that circles back to the idea of like, don't sell.
Exactly. That's one of the other benefits. Don't sell. Don't pay the real, there's sales fees, all that sort of stuff. Yeah.
Exactly right. I'm a real estate agent telling you guys not.
Yeah.
It's just crazy.
Yeah, exactly. It's against your interest. And then one other thing. So one other thing is redraw facilities and offset accounts. So my opinion on these is like, a lot of people do love them. Offset accounts can be really handy. I think if you've got a little bit of money in the bank. I mean, essentially for people that don't know what an offset account is, it's basically the money that is in your offset account is what you will not pay interest on against your mortgage. For example, if you've got a $300K mortgage, you've got $50K in the bank in the offset account, you're only paying interest on $250,000, which is 300 minus the 50, which is good. That you might save 5% or whatever your interest rate is.
Mm-hmm.
But I would personally rather invest that, because you can get a higher return than the interest.
Exactly.
That is the whole point of investing.
Yeah, exactly. And another, you were going to say something?
I was going to say redraw facilities are quite similar in that way too.
Exactly. It's basically the same thing, I think.
Yeah.
Cool. But the thing is, I think with those offset accounts, they're usually sitting on variable interest rates, which means that it's going to flow with the change in the interest rates, which is favorable now, but also fixing it also is not a bad idea, depending on what type of the market cycle you're in right now. So in Australia, we can fix interest rates up to 2 years. In the United States, you can fix up to 30, which is crazy. But if the interest rates are low, why wouldn't you just fix it? Instead of trying to, you know what I mean? And then just with the money that you make, just invest into a new investment where you can just bankroll that anyway, and you got money left over. And if you think the interest rates are going to rise into the future, like even in the next few months, just fix it. But with fixed interest rates, to refinance that, there's going to be higher costs involved in it as well. So,
like a break fee.
That's like a breaking fee involved in it as well. But the thing is, even with each refinance, you consider all of those numbers in, factor it in. And I think there are loan products out there that will just even factor in the breaking fee into the capitalization of the loan itself. So you're borrowing the money to break the fee, like for the break fee as well. So if it's like $1,000, $2,000, you just borrow $1,000 or $2,000 more on the subsequent loan that you're doing. So you're just capitalizing all of that in there. So I think, yeah, I mean, I think we've talked about this before we started our podcast, is if you're asking the question, should I use variable interest rates or offset accounts or not? Look, whatever. My answer is whatever. If you want to use it, go for it. If you're somebody that holds a lot of cash, do it. But why are you doing that? Are you doing that literally just to save 4%, 5% to the dollar of your cash? Well, if you just spend the money on the right places, you're going to make more than 5% to the dollar. So why wouldn't you? Which is what you basically said. So having the question of should I use variable interest account or not is the wrong question. It purely depends on the speculation that you have on the interest rates and its changes in the near future, being the next 2 years.
Exactly. And that's the key word there. It's like speculation, because you don't know, but it's like, I think risk appetite is something a lot of people don't have much of. They're pretty risk, averse. So, but the risk is in what you don't know. That is literally one of my favorite sayings. You can mitigate risk by learning more about it and actually doing it.
Exactly right. And I think if you want to have a offset account and you like the idea of it, because it's not like you get paid 50 grand just like overnight. You're going to build up to 50 grand. And if you want to just, leverage that, that saving of your interest rate up to that 50 grand, my suggestion is sort of split your loan into two sections. So if you borrow 400K and you think you'll have about 50 to 80K in there, put like 100K on variable and put the 300K on fixed. So that on the 100K, you can then offset that, up to about 100K. There's no point having like a 500K on variable and putting that entire thing on offset if you're making 80 grand a year. The chances that you're never going to have 500K in your bank account to offset the entire thing. There's never going to be that amount of cash sitting in your bank account to be able to do it. So you can split it up as well. Again, these are all discussions that you should be having your broker. And these are all the things that I know because I've had the same discussion with the broker as well. So the more you do, the better you'll know. If you need the right help, reach out to us.
Yep.
Thanks for tuning in, guys. Young Money Hackers, come check out our website. There's a lot that we can do to help you guys to get rich. That's why we're here. Thanks for tuning in. Make sure to like, share, subscribe. We'll see you next time. Peace out.
Cheers, guys. See ya.